All right, Abe, Jason, are we good to kick things off?
Let's do it.
Yeah, let's go.
Awesome. Let's go ahead and get things started. Thank you all once again so much for joining us today. My name is Madison, and I lead marketing here at AngelList. For those of you not as familiar with AngelList, we are building the infrastructure that helps power the startup economy. So we focus on providing startups and investors within private markets the software and services they need to launch and scale a startup in a fund or invest in both. A bit of background on AngelList before we dive in is I wanted to give some context into the State of Venture report. So over the past around 10 years, AngelList has had around 20,000 plus funds and syndicates launched and funded on our platform, along with 12,000 plus startups, including hundreds of unicorns, who have raised over $8 billion through the AngelList platform. In the past 12 months alone, we've had more than 85,000 investors on AngelList, including 1,000 GPs who have made investments. So by virtue of the volume of investment activity on our platform, we can take a deep look into early stage venture activity and identify trends within the early stage investing universe. With this, we release a State of Venture report each quarter that highlights and identifies trends we see within the industry. We are beyond excited this quarter to partner with Brex to create this report for Q2 2023. If you're not familiar with Brex is the first fully unified global spend platform with corporate cards, expense management, reimbursement, bill pay, and travel all in one space, and they serve tens of thousands of businesses from enterprise to startups. They make it easy for finance team and founders to manage every aspect of global spend at scale by empowering their employees anywhere to make better financial decisions. This quarter, as I mentioned, we've partnered with Brex, who has exclusive data on startup spending activity, and paired this with AngelList's venture market data to provide a comprehensive and timely overview of how capital is currently flowing in and out of the startup economy. With this, I'm joined by Abe, AngelList's head of data science, and Jason, Brex's head of startups. I'm going to throw it to each of you to quickly introduce yourself. Abe, why don't you go ahead and kick us off?
Thank you so much, Madison. Hi, I'm Abe. I started the data science team at AngelList. I do research into startups and the venture economy and lead AngelList's data-driven investing efforts as well. We're super excited. This is our first quarter that we're working with Brex, and really excited to share the stage today with Jason.
Thank you, Abe. Excited to share the stage with you. Thank you, Madison, for partnering and hosting us, and thank you, AngelList, for the partnership. So here at Brex, I'm currently the head of startups. I joined just a few months ago, and what we do here at Brex is, as Madison mentioned, we scale with companies from inception all the way through IPO, and we segment companies across startups, mid-market, and later stage enterprise. And so with me and my organization, we deliver the best we can for Brex across go-to-market, relationship management, product strategy, and community for Brex in the startup community. And I'm looking forward to diving in with Abe and sharing more perspective on what we're seeing. Thank you.
Awesome. Thank you both for being here today and taking the time to not only help with the report, but then share additional insights to the crowd today. Before we get started, I'm just going to go over a few housekeeping items. So we'll go ahead and kick off today's discussion by diving deeper into the report. Abe's going to take us some time to go over the AngelList data and add some additional commentary around the insights, findings, and what this actually means for the venture industry. Then we're going to turn things over to Jason, and Jason's going to dive deeper into Brex's data surrounding startup spending and the implications that this has not only for Q2, but for future quarters. We'll end with about 15 to 20 minutes left, and that's when we're going to go ahead and take audience Q&A. However, we encourage you to submit Q&A throughout the entire things as questions come to mind. There is a Q&A chat box that you guys can all drop those questions in, and our team will work to consolidate those for the end of this conversation. We are also recording this webinar, so later this week, we will go ahead and be sending you all an email with a link to the report and a link to the webinar in case you would like to rewatch it or send it to anyone you think might find it interesting as well. Without further ado, I'm going to go ahead and hand it over to the experts. So Abe, this is where I kick things off to you to start. I'm getting into the meat of the report.
Awesome. Thank you so much, Madison. So we'll go ahead and share the markup rate slide. So you can think about 5 things happening to a startup's share price in any given quarter. For the vast majority of startups, it's a slow-moving process, and price discovery generally only happens In fundraising rounds, that can happen 12 to 36 months spaced apart. So the most common thing to happen to a startup's share price in a quarter is nothing. And in general, about 90% of startups see no change. There's no information about the startup, no updates, no financings, no shutdowns. So that is the majority of startup activity that we see. But there's also 4 other interesting things that can happen to startups. They can do a price equity round at a higher price than their last price per share. They can exit at a higher price per share than their last financing. They can do a down round where the price per share decreases. It's worth noting here that all our data, AngelList data, is on a price per share basis. And so oftentimes what will happen when a startup actually does a down round is the valuation that they broadcast will be a flat round. The headline valuation will be flat, but what that startup has actually done is take on additional dilution and decrease their price per share. So that would actually be marked as a down round with our data, even if the headline valuation looks the same. And finally, exit down, which is could be an acquisition at a price below the last price per share, or more typically, the company is just winding down and returning a fraction of money back to investors. So we track these 5 things, or really these 4 important things, for every startup that AngelList has timely price per share data on that is active. And so the way we slice that is we say a company's active if it hasn't exited in the past at the start of the quarter, and we say that we have a seasoned investment in that company if the earliest AngelList investment that was made into that business was at least 6 months old at the start of the quarter. As it turns out, AngelList has access to about 15,000 startups, active startups that we have seasoned investments into. So this is a really big early stage tilted view of the investment universe. And we can track what happens each quarter by these 4 metrics. Good things from the perspective of startups, markups and exit ups, and bad things, markdowns and exit downs. So we've been doing this now since 2016, tracking the behavior and activity. The dotted line on the top chart here shows the median, sort of what happened and is it positive or negative. And in the second quarter, actually, we're as close as we've ever been to actually seeing a balance between positive and negative activity. That is caused by especially relative to where things were at a year and a half ago, a huge decrease in the number of markups of startups, and a not really too much of an increase in markdowns or shutdowns, but really just priced equity rounds at a higher price are rare, are very increasingly rare to come by over the past 18 months. So you can see that decline in kind of the green area over really kind of like the past 18 months or 2 years. Another way to look at this, Madison, we go to the next slide, is the dot plot. This plot got dragged a bit on Twitter, so I'm going to take this opportunity to sort of defend it a bit. What we do here is we can describe activity by 2 dimensions. The x-axis here is activity rate. The y-axis is tenor. So the x-axis measures, how many startups changed their price per share over the quarter. I said that typically that's around 10%, but obviously it can be from, this plot shows sort of like something like 5 to 15% would be the variation we've seen. And then on the y-axis, the percent of positive activity observed. So of those startups that changed their valuation, how many of those changes were increases in the price per share. This has generally always been above 50%. Some reasons why could be that essentially, my thinking on why this has consistently been the case is that startups tend to raise when times are good or they're doing well, they tend to raise more frequently. And then, if the company does end up shutting down, there'll be a very kind of long gap, and then you'll get, companies sort of take the stairs up and the elevator down. So, you'll get one update of a catastrophic wind down in this business, but maybe you had, 3 or 4 markups along that way. So this does tend to skew positive. But what we see, unfortunately, from this perspective, So these are our two axes. The x-axis is the activity rate. The y-axis is how much of that activity was positive. And we can characterize like good and bad times by those measures. So in awesome times for venture capital and awesome times for startups fundraising, there's a lot of activity, and that activity is really positive. So we kind of hit that peak, for instance, around 2 years ago, kind of the pandemic bubble, if you will, or boom. 12% of startups change their valuation, and of those that change their valuation, like 90% of that was markups. Now, 2 years later, we're in a very different place. In the second quarter, fewer than 6% of startups changed their valuation, and the percent that of those that changed their valuation was closer to 60% had priced up rounds. So this is actually very interesting. The reason that this plot has all these dots and all these lines, the lines connect individual months over time. So the point of this plot is really to show, for a long time, behavior pretty much moved on a northwest to southeast axis, where if you had more activity, that activity was slightly worse. If you had less activity, that activity was slightly better. The pandemic really broke all that. We sort of soared to unprecedented heights about 2 years ago, and now we're kind of in unprecedented depths today. So you can see also as well, we've marked off, where the April 2023 data point would be the first quarter of this year, and the Jan 2023 data point would be the fourth quarter of last year here. So you can see, unfortunately, there's been a big motion from 2 years ago in the southwesterly direction of this chart towards the bad times label on this plot. And just as an amusing data anecdote, I don't mean to trivialize what's happening to the startup economy, but when times were really good, 2-3 years ago, I actually had to move the boom times label on this chart because the dots had started encroaching on it. And now, unfortunately, in this most recent quarter, I had to move the bad times label on this chart because now, unfortunately, times are so bad that it started encroaching on that label as well. So none of this is typical. None of what we've seen really since the second quarter of 2020 could be regarded as sort of like the typical venture activity that we sort of expected to see. We are still waiting to return to normalcy. You can see on this plot, like about a year ago, like the second quarter of last year, the pattern of activity and behavior was, relatively normal, kind of within that massive dots on the northwest to southeast axis. But it was clearly a kind of an intermediate stop between a huge boom and what is now seems to be like an unprecedented kind of bust. So we are still waiting for a return to venture normalcy. We have a blog post up kind of looking at the relationship between the public markets and venture markets. And we think the lag, especially at the early stages, is long enough that it can be as long as nearly 2 years. So we're not really forecasting a return to normalcy until 2024, and that's assuming that public markets, I don't think they need to be exactly as robust as they've been over the past quarter, but as long as they don't as long as nothing catastrophic happens in the public markets, we're still not forecasting a return to normalcy until sometime next year. That is useful to think about in terms of the relationship between public markets and early stage markets for our next slide. So we're looking at valuation quartiles of various rounds that AngelList has data to. What's interesting, and these are typically on the order of hundreds of deals in each of these categories. So maybe not Series B, but for certainly like the C deals, we're pushing hundreds of deals in a quarter. So this is pretty good and robust data on the valuations of companies for deals that closed in the second quarter. What's interesting about this is that pretty much all of these values, and we use median. I always prefer using medians, quartiles, as opposed to averages, because everything else in venture, things are skewed by power laws, and averages would significantly overstate sort of the actual valuations that are faced by startups and investors in the market. All of these values fell close to 20% actually quarter on quarter in terms of the medians. However, I think we're in a very different place. I think what we saw with later stages are closer to the public markets, and so they're more responsive and they operate on a shorter window to what's currently happening in the public markets. Whereas early stages, it takes a lot of feedback for what's happened in public markets to feed back into early stage pricing. So, seed round prices have only started falling really in the past 6 months, whereas Series B prices started falling, within 6 months of kind of the initial market crash back in the first quarter of last year. And so I think what we're capturing here is a bit of an imbalance in transitions between the various stages. Like even though these values generally all fell about 20% quarter on quarter, it would not surprise me if we're very close to the bottom of observed pricing in Series B. We estimate that Series A pricing will probably fall to something like a $35 million pre-money median. And then seed and pre-seed still has actually a ways to go. The seed rounds have fallen from a median of 20 million pre-money to, we think it may go as low as 12 million pre-money valuations. And so seed has really not even, or maybe only made up like half of the valuation falls that we think would be associated with return to typical venture activity. Whereas we think that, Series A is maybe 2/3 or 3/4 of the way there, and Series B might be there sort of already. So what we see is essentially as public markets are recovered, like when public markets fell initially, the later stage rounds started falling very quickly in valuation, whereas seed and pre-seed was like very, very robust. Like the median seed round kept a valuation of $20 million up, I believe, through the fourth quarter of last year. Months and months and months after the public markets had started falling. On the other hand, though, now that public markets appear to at least be on a path to recovery, that will not, we don't believe that will immediately filter into early stage rounds. Actually, what we'll see the kind of a residual overhang of valuation falls in the early stage rounds, whereas we think later stage rounds might actually even start increasing in price because they're more responsive to what's happened in the public markets. So this is definitely, even though it's a little bit misleading, if you look at the report and you see, it seems like all of these rounds fell, about 20%. I think that's actually sort of a bit misleading. I don't expect for them to continue moving in lockstep. I would expect over the next quarter or two that we will see a divergence where seed and pre-seed prices will continue to fall, whereas Series B prices, I would not be surprised if we saw an increase in at least in median rounds over the next couple of quarters. So speaking of rounds, so this is the count of deals in AngelList. And I think the most important thing to pull out here, especially as it relates to last slide, is the biggest trend or phenomenon that we've seen sort of over the past few years has been the rise of the pre-seed round versus seed rounds. So seed rounds obviously continue making up a large fraction of the deals on AngelList, but pre-seed rounds have really, really increased. And in fact, so if you go back actually several years, like 2019, pre-pandemic, the ratio of seed to pre-seed deals was something like 5 or 6 to 1. Now the ratio of the deals is more like 2 to 1. And so one of the reasons that, and actually was smaller than that last quarter, in fact, one of the reasons that we see resilience in the pricing, so there's a little bit of a trick there, because one of the reasons that we see the resilience at seed prices have remained high when you look at the price of the median seed deal is that a lot of deals that used to be considered seed deals are now being labeled as pre-seed deals. Essentially, these are actually two things that are really hard to tease out from one another, because most of those investments are done with safes. And there's really no difference. It does not involve a priced equity round. It does not involve a professional investor taking a board seat. So it's actually really difficult to tease out like why is this round labeled pre-seed versus this round labeled a seed when they're just a safe with a different valuation cap? The only difference between the two rounds in composition is that there's a minority, about 20 or 25% of seed deals that use priced equity, whereas virtually no pre-seed deals use price equity. So this change in composition will result in, I would expect wherever the bottom is found for seed deal pricing, if this phenomenon of kind of like deal labeling between pre-seed and seed deals holds up, what you'll see is that the seed deal prices will be higher than you'd otherwise expect, because a lot of the lower value deals will just sort of be possibly arbitrarily or possibly, in a sophisticated manner, relabeled as pre-seed deals. We always like to keep track of the deals and funding to female founders. I think one of the, obviously the venture market has changed quite a bit over the past couple of years, and something we like to just keep track of is that affecting female founders more or less than kind of the market as a whole. I don't see any particular trend in this data, possibly a slight increase in terms of capital over the past few years, but there's essentially no relationship, which it does not suggest that there's been a pullback in financing to companies founded by women. And then one thing, looking for bright spots within this market, certainly a bright spot is, if you go back at this chart from a year or two ago, what you'll have seen is sort of Web3 and fintech were number one or number two, and AI ML has always been popular. It's not like this is a new category, but it was sort of a top five. And over the last quarter, it is now kind of the number one category for deals on AngelList, our AI and ML deals. And that's a combination of several factors, right? Like companies that are using large language models to provide a service, companies that might be like, sort of like if you're, I don't know, you're running like a SaaS marketplace or something, but you use some machine learning, maybe you're more excited about tagging yourself as a machine learning company now than maybe in the past you would have tagged yourself as like a SaaS or like a marketplace. And then, just the tooling and the ecosystem for AI and machine learning companies. So there's sort of like, there are like three kind of different categories or classes of these companies that are sort of coming online, and certainly seeing AI ML kind of capture the top spot of deal types is maybe not surprising, seeing the level of enthusiasm and activity that large language models have seemed to capture over the past 6 months. And one of the reasons that I am so excited that we partnered with Brex for this quarterly report is Brex actually has like terrific data on how startups are using some of these new AI tools. So I think the handoff here is going to be, I'm going to hand things over to Jason to talk about the really incredible Brex data they have, showing the rise of customers for these AI, AI APIs.
Thank you, Abe. Appreciate it. We can go ahead and dive to the next slide, Madison, please. Terrific. So as Abe mentioned, we've got tremendous data on the spend side in regards to how startups, seed, early and later stage companies are spending. I'm going to walk through the slides and share some perspective, and then obviously we've got time for Q&A to dive in deeper if anyone has questions. So on this slide, just to be super clear, and you can see it in the headline, this is the number of customers spending on select AI merchants, not the number or not the amount of spend across different AI merchants. Those are two very different things. But the reason I highlight the number of customers is you can see right now, in addition to OpenAI and Hugging Face, very important, Fireflies and Otter AI, both note-taking transcription tools. I know this pops up probably for many of you on Zoom and whatnot, but really leading the charge. And what we're thinking about here in Brex, I'd love to hear in the comments or later in the Q&A, other tools that you foresee up and coming as companies continue to scale. But right now we're seeing a big explosion, obviously, on transcription, note taking, etc. But given the explosion in general of the popularity of AI, what's interesting right now to observe is a couple of things. So from a spend perspective, we've seen AI continue to be and again, this is number of customers, but just holistically on a spend perspective, we've seen AI continue to be an increasingly large amount of spend. On the data that we don't show here, we did see a little bit of a dip in Q4, and that was because of the release of the free version of ChatGPT. But then we saw a rise here in Q1 and Q2 as ChatGPT offered a subscription model, which a number of our customers, Brex customers, jumped onto, and then you see like just that massive rip across Q1 and Q2. And fortunately, it's at a very cost-effective price point, such that we haven't seen it dramatically impact spend or become too much of a bigger piece of the pie for overall AI tooling spend. But the other thing to note too is just as we continue to look at this in terms of number of customers and then behind the scenes the amount of spend, we've also seen a 70% year-over-year increase in number of AI customers that we at Brex serve. And so, as Abe just mentioned, AI continues to lead the way, and it's going to be exciting to see where we end up, towards the back half of the year and going into 2024. So we can go ahead and jump to the next slide. So great. So I come from a finance background, both prior at SVB and A16Z, and so this slide speaks to me. So obviously, to be very thoughtful with the data, we want to make sure that we didn't put anything that anyone could just kind of read into too much on the X and Y axis. And then, because we have seed, early, and later stage here, it might be hard to go ahead and dive into, exactly kind of like the actual gravity of how much each of the the stages are moving in terms of spend, but I'll go ahead and break it down. And so given the slowdown in fundraising activity and the overall kind of macroeconomic environment, it is across the stages, apparent. And then, as you would expect, there has been a slowdown in company spend. Now, the one thing to highlight here is this is purely company spend on a Brex card. So this does not include anything related to compensation, which, again, we kind of skew a lot of this stuff in a different way. So this is purely company spend on a card. And what we've seen over time is that, across seed, we've seen a 16% year-over-year reduction in company spend. At the early stage, we've seen a 10% year-over-year reduction. And at the later stage, we've seen a 3.8% year-over-year reduction. So as you can imagine, it gets more pronounced at the earlier stages, but then on a volume basis, those numbers are bigger. And so again, this is purely just average quarterly spend by company stage and is not inclusive of compensation or salaries or sales or whatnot. We can go ahead and dive into the next slide. Great. So we've got 3 slides in a row that really kind of articulate trend lines across company spend by merchant category for seed, early, and late. And so I'm going to go ahead and pause here for a second and kind of share a perspective on seed, and then we'll kind of go to early, and then we'll go to late. But here, what you'll see on the seed slide is that, the 3 I'd really love to hone in on would be, marketing and advertising, T&E, and then recurring software and servers. And so on the marketing and advertising side, holistically across seed, early, and late, what we're going to go ahead and see if you did merge the graphs is a decline over the past 2 years in regards to marketing and advertising. On the flip side, what's kind of averaging out, what we've seen kind of peter out and average out is like a slight increase in uptick on marketing advertising on the seed side. You'll see a decline on early and late when we get there in a few. But on the marketing and advertising side for seed, our hypothesis and continued perspective is that, as companies raise pre-seed seed, it's important for them to get their name out there. It's very noisy out there. There are a lot of different platforms. And so Google and Facebook continue to be the biggest merchants we see across seed, across pre-seed and seed spending. And then obviously, as you can imagine, TikTok is up there too. And then again, we've seen that kind of peter out a little bit for marketing and advertising on the early kind of series A and B, and then later stage side. The other thing to note here too is on the seed stage side for merchant categories in regards to like T&E, that has had a big rebound. And you'll see that too in the later slides. We are back at pre-pandemic levels in terms of just travel and expenses and T&E. And on the seed side, it tends to be traditionally Uber as one of the larger merchant categories, and then you'll get to it later. On the early and later stage side That typically tends to be airlines, and we see a lot of United, Delta, and American. And then last but not least, recurring software and servers. For Seed, that is relatively flat. Now, as you can imagine, right, going back to the start of the pandemic, remote work, obviously we all moved into that shift, and that recurring software and server spend category was continuing to rip. It has since kind of flattened out at the Seed, as companies have a hybrid model and have kind of really reined in and managed, a lot of the spend in regards to just predominantly AWS and Google Cloud. And then we've seen spend across Zoom and Slack pretty much flatten out. And then you'll see, as we dive into, the different stages, early and late, and Masson, if you don't mind, we go to the next slide. You'll see a little bit of a different perspective here at the early stages. And so, as I mentioned before, marketing and advertising spend is slightly down. T&E has dramatically rebounded to pre-pandemic levels. And again, that's predominantly airline spend. And then, as I mentioned before, recurring software and servers, like that spend has somewhat flattened out. Again, as I think a lot of companies have the infrastructure in place that they need and are being thoughtful about managing spend because they don't need to kind of get everything up and running as you would normally do if you're a pre-seed seed stage startup. And then the next slide is the later stage spend by category, and you can see an even more pronounced, dramatic decline in marketing and advertising spend. And then I mentioned this earlier, but again, like you see the rebound in T&E, and then you see it kind of normalize and flatten out. Yes, we see a little bit of an uptick, in regards to recurring software and servers at the later stage, but that that's been relatively flat. Like if you look at it over kind of a 2-year time frame. So as we dive into the next slide, if you don't mind, we'd love to go ahead and just kind of shift to how we think about things globally. And here at Brex, we think a lot about how do we enable borderless transactions and how do we support all of our customers globally. And so without sharing too much in terms of who's going where, what we thought would be interesting is really just to go ahead and share exactly the average number of countries transacted by quarter, by stage, so seed, early, and late. And what you'll see is a couple things as you would expect. But again, everyone's transacting more globally. And then across seed, 4.4 countries, early 5.7, and later 7.7. And so what effectively this means, without kind of just reading the chart to you, is, our perspective is really, at the end of the day, the global economy becomes more interconnected. We think that there's a lot more that's happening outside of the US, obviously. But what's more interesting is if you can kind of reflect back to 5 to 7 years ago, the global startup hubs and where companies from the US, domiciled in the US, would transact, that was really siloed to just a few countries, 2 or 3, maybe even 1 or 2. And now what's great is we see a lot happening across all of Europe, Paris, France, London. We see a lot happening, obviously, in Tel Aviv, and then obviously the explosion in Latin America. And so what this is just articulating is that our companies are spending across an average number of a lot more countries, and we're excited to go ahead and in future in future opportunities share more about what that means and where we're headed. And then on the last slide, if you don't mind sharing, Madison, would be just again percentage of companies headquartered outside of Silicon Valley, and really again this is really driven and built on that a lot of the Brex customer base data. But what this is just meant to articulate is we do believe that the historic kind of startup hubs of San Francisco, New York, LA, Boston are holding their ground. And this is just really going to promote, and what out there is that, as we continue to move into this remote hybrid world post-pandemic, and as doing business and as scaling companies becomes more streamlined with all the tools that we have out there, we're seeing a lot more companies find ways to and operate successfully headquartered outside of Silicon Valley. And those are the obvious hubs of Austin, Seattle, Miami, others. And so it's just great to go ahead and see that, it really is kind of balancing out, and that not everything needs to happen in SF in Silicon Valley or New York, and that companies are able to really kind of scale from anywhere. So I believe that's the last slide, and then we can dive into Q&A. Thank you.
Of course, that is the last slide. Thank you so much. Abe and Jason, for sharing your additional insights. So we do have time to address some of the Q&A that have been submitted before this and then also during it. It's not too late. If you do have any additional questions from the topics that Jason and Abe both mentioned, feel free to drop it in that Q&A chat should be the right-hand side of the screen. We will go ahead and dive right into the first question, and that is for Abe. So Abe, the first question was, does AngelList have a process to proactively mark down investments to zero due to founder or company inactivity? For example, if you've never heard from the founder, there's no investor updates, the website no longer works, etc. And then supporting that one is if you could define the return to normalcy, presuming 2021 market was not normal.
Yeah, it's a great question. So if you recall back on the infamous dot plot slide, we had said sort of prior to the pandemic, kind of prior to the second quarter of 2020, there was a general trend of sort of activity moving in a direction where activity and the positive activity was negatively correlated. And that, I think, is a function of actually the AngelList valuation. Of anything, it's a function of the AngelList valuation policy, which is we try to keep things updated at least every 12 months. What that means practically is if it happens. I mean, I'm a startup investor. It's happened to several of my startups. Like sometimes when a startup winds down, the founder sends, an email about their journey and, how, they didn't quite work out the way they wanted to. And other times they just fall off the map completely. For the companies that wind down in the second way, that does end up on AngelList, but like the actual month that gets reflected as a write down is essentially random, right? Because it's not like there was some, event at which the company like, oh, this company's not a company anymore. It just sort of stops at some point, and then when it gets noticed is kind of random. And so what that means is it applies this sort of like, it's a random negative shock that can show up, either a month before or a month after, and as a result, you get this, that I think is what produces a sort of historically negative typical correlation between activity and how positive that activity is that like when you see more activity, some of that activity you're observing was just like, oh, I happen to just note that like I just happen to mark down more startups that month, but those markdowns could have been from the prior month or it could have been the future month. So that's explaining that sort of negative correlation, and that also is why like that's to me what like a typical, which is what it looked like sort of prior to the second quarter of 2020 venture activity looks like, which is that sort of like put a point like in the middle of that cloud. It's at about 10% of startups change their valuation a quarter, and about 75% of the activity is positive. And if you observe more activity, it's less positive. If you observe less activity, it's more positive. That would be like like that's what if we see that behavior happening, like that's what I'd call like typical venture market activity. Starting in the second quarter of 2020, we've just completely gone off those rails and seen a lot of behavior that has actually moved in the other sort of principal axis towards like southwest, northeast. So actually positive correlations between the activity rate and how much of that activity is positive. So when things got super boom time bubble, 2 years ago, activity was moving, there was a lot more activity and it was really, really, really positive. And now, there's a lot less activity and the activity is almost split 50-50 between markups and markdowns. So part of the return is like a general return of like, yep, this is, we're at about 10% and 75%. And part of it is just the return of this negative correlation between, if we see more activities, it's like usually a little worse, probably because we're just seeing some markdowns that maybe could have been spread out over other months. If we see a little bit less activity, it's more positive, probably because we aren't counting those markdowns that we'll end up counting in a future month. That's, to me, when we're back on that kind of northwest to southeast axis, that's what venture normalcy looks like to me. And we are far away from that right now.
Got it. Thank you so much. And then Jason, this next question is for you. So I understand that the financial discipline is on the rise as startups look to extend runway. So based on the data and your expertise at Brex and from your background, what types of behaviors or practices help a founder practice financial discipline and understand where to make spend trade-offs?
Great question. So I've been in this industry for 19 years. And what, I think through different cycles, I've seen and we've noticed in general, is that, what's really important is for the founder to have visibility across the org, especially at the pre-seed and seed, on how spend is happening and to make sure they have the right policies and controls in place to maintain control over that. And there's, this may resonate with some of the founders out there that are watching, which is, sometimes it's really hard as a founder to kind of play CFO as well. And so what I would then acknowledge is, I go ahead and kind of have a hit list of 3 things that I was jotting down as you were mentioning that question that I think are really super important. And so one is it's never too early to employ a corporate spend policy, really to understand no matter how big or small your company is, even if it's 3, 4, 5 people. And this really kind of does parlay to, this is not a pitch on Brex, but this really does parlay into like why Brex exists, is to enable companies at all different scale and sizes to go ahead and manage spend. And so it really is important to just not hand out a credit card to everyone unless you have a spend management policy in place with budgets that you can assign to ensure that people are spending money in the places in which you have designed in terms of just kind of managing runway and corporate spend. And so one is get a corporate spend policy in place and then have a process in place and a financial partner in place that enables you to execute and exercise that. The next thing is, as you are thinking about how and where to spend, and as you saw earlier, like marketing and advertising is one of the larger buckets across the different merchant spend categories. Again, I know this is really hard at the earliest of stages because you're kind of A/B testing, you're trying things out, you're trying to figure out your go-to-market strategy, et cetera. But having some philosophy or framework in place for like, how do you assess how much you should spend across different channels? It might be really early to like measure CAC and think about all of that. But what's really important is to just have somewhat of a framework so that you're not kind of throwing money at 10 different channels and seeing what sticks to the wall, but have a plan in place to kind of A/B test what makes sense across Google, what Facebook, LinkedIn, et cetera, and the different channels out there, just so you can kind of be mindful and thoughtful about that and not let that creep in to be too much as a part of your spend. And then last but not least is it's also never too early. And I mentioned this a little bit before, but it's never too early to get finance help. And so I've seen way too many founders, amazingly smart people, try and also play CFO and learn on the fly. And that takes you away from company building and that takes you away from the other day-to-day. And some of that rigor and discipline that we talked about that can help preserve runway and manage spend kind of gets washed or diluted in that process. And so it's never too early to jump on out of Brex or any of your other investing partners who can kind of make recommendations as to, getting consulting or part-time, controller, CFO help at the earliest stages, getting a budget in place, understanding how long your runway lasts, and then making sure that you've got the budgeting controls in there and that you're properly spending on the right channels is a great way to go and think about financial discipline, especially at the earliest of stages.
Yeah, I think that's a great point. Founders wear so many hats in general, but being able to focus on the company, the growth strategy, and then tag team in some partners to help with the financial area is never a bad decision to kind of look into or explore, at least at those stages. Abe, we'll throw it to you for the next one. The question from the audience was, have you seen Carta's Q2 report? Any thoughts as to why they saw around a 25% uptick in capital deployed from Q1 to Q2, while AngelList's Q2 was considered the worst quarter ever?
Yeah, so I think the discrepancy might come down to a couple things. So I don't want to, I don't have information about what Carta's kind of data looks like and the way they assemble it. But my understanding is that they tend to do some pretty large data revisions. Sort of like how timely is the data? How much does it need to be revised? If you publish a quarterly report, but you don't have, what happened in the month of in the month of June, is it really a full quarterly report? So my understanding is that Carta does tend to do like pretty significant retro revisions to their data stuff. So we tend not to. We kind of have everything at the first day of the new quarter. So I would not be surprised if there were some retro revisions to the Carta report. The other thing is that we very consciously, when we look at activity, we do not look at parametric statistics. So we try to do non-parametric statistics like counting-based statistics and not averages or sums. And the reason why is that venture is virtually everything in venture is ruled by power laws, which are distributions that have these extremely huge outliers. And so if you look, like the average is not what is happening to the typical startup. The sum is not what's happening to the typical startup. And so we tend to only look at counting-based statistics. Like you saw that, for example, there was a question on this. In our quarterly report about what happened and which sectors were taking on money this quarter, food and beverage had this anomalously huge amount of capital raised towards it. That comes from a single deal in a late stage company that I don't think is public, so I'm not going to talk about what company that is, but that came from a single deal. And so if you're an entrepreneur in food and beverage and you're like, oh, food and beverage is like the hot space to be, it's like, no, you're not. That was one deal, and that deal was not your company. And so I think if you look at things like capital deployed, you can very easily get a skewed view of what's happening in the universe. That's why we always prefer, taking medians, taking quartiles, doing counts, and never, we try to really stay away from averages and sums, because those will just, venture capital is not a pleasant, normal distribution that you can aggregate well. It has these like really extreme outliers that are just, that are not instructive for the founder at a typical startup.
Yeah, that's super helpful. And I think you just spend a lot of time on like how we aggregate the data, how we show the data, our methodology behind it as well. And I think one of the things that it's so easy to consume this data, read the report, see the stats. But Jason, I kind of want to flip the switch on this question as well and say, like, with looking at this data from Brex and from the entire report, how do you see this like shaping or informing how a founder might actually think about fundraising in the next 12 to 18 months? So taking all of this and saying, okay, what does this mean moving forward for me and for my company?
For sure. We can TLDR it and then we can go back to Abe to see if he agrees or disagrees. But look, if you look at the data, and again, there's AngelList data, and then as Abe mentioned, there's there's different ways in which Carta and other people look at data. Like I think we can all feel it in the ecosystem right now, is that like fundraising slowed down a little bit. Whether at the bottom or not, who knows? But yes, the data kind of implies that like things are kind of petering out. And the thing that we haven't mentioned yet, which which I think is super important, is like everything that happened with SVB did slow things down. It did. And like that's also a big asterisk in there, and in any way, shape, or form, because it really kind of slowed down the plumbing for like how people get money. So with that being said, it does feel like things have kind of normalized in a way where I'll provide three takeaways. One is, as mentioned, from the data that you see, I would look at this as, it doesn't need to be doom and gloom. I would look at this with optimism, meaning one thing that's not reflected here, but we all know, is there is a ton of capital on the sidelines, a ton, just waiting for the right time to pounce. There are a lot of investors out there, seed, all the different stages that really have a ton of capital. And I think there are reports from even last year, like that capital hasn't moved much because, as you have seen with the data, the fundraising data has declined a little bit. That's okay. Good companies raise in all times. And what this means is it feels like we are gearing up. Who knows for when, but things will likely start to pick up in September as for when VCs, founders are ready to have those conversations. And so what I would say for that is be thoughtful about when you want to go and fundraise. Do not get discouraged by the data or by the lack of conversations you're having right now, because timing is of the essence and timing is also everything. And just be really thoughtful about how you're positioning your company. And then, as I mentioned before, setting yourself up for financial success by having the rigor now to fundraise when you are ready to fundraise and not have timing drive you to a fundraise. I think we can all acknowledge that it really is important to make sure that your back is not up against the wall to have to fundraise at a point in time in which maybe the seasonality is a bit untimely and a little bit slow. And so by employing some of the stuff that we mentioned earlier in regards to financial discipline, financial rigor, thoughtfulness there, it really is starting to think through like, where's my product? When do I want to have the conversations, as I think about somewhere in the second half of the year going to 2024, and then how do I make sure that I have the financial rigor to make sure that the company has enough runway and capital to get there? And how do all my investors whom I talk to at that point in time have trust and credibility with me in terms of me knowing how to manage my cash during this kind of macroeconomic time? And so I hope that answered your question, but I think in general, TLDR is, it's good and nice to look ahead with optimism. I think that there's plenty of opportunity to fundraise. We're in a little bit of a dry season right now. As I mentioned, it maybe feels like we bottomed out, but as we all look to bright and rosy and sunny days ahead, it's important to plan for that and to make sure that you've got ample capital to get there.
I think Jason made a couple of good points that I want to expand on. So the first was Jason referred to what happened with SVB. That went down in early March, but what we measure for our quarterly reports, and one of the reasons that we don't really do significant retro revisions, is that we look at finalized deals within the quarter. And deals can take weeks to finalize. So actually, in April, which was part of the second quarter, will include deals that were in flight when SVB went under. And so there is some, the data that we're sort of directly reporting on, today, it still has, some of those deals will still have a lot of resonance with what just happened with SVB. So I think we should not continue to ignore that or say, oh, that was months ago. It's still in the data. It's still affecting the market. In terms of how founders can think about fundraising and stuff, I think it's actually, I do expect, if you were running a Series A or Series B company and you're interested in raise, this may be a great time to raise money over the next few months. We do think that prices will start to recover. For seed stage, I think it's a little bit more mixed, right? I wouldn't expect a full recovery in seed to Series A financings until next year. And so it's kind of but also those prices are probably going to continue falling. So it's a little bit of a trade-off. If you're crushing it to the point, deals are still getting done. If you're crushing it to the point that you can go out there and you're obviously going to be able to raise a Series A, doing it now could be good and possibly secure a higher valuation that will, probably be covered in the future Series B valuations, and you probably don't have anything to worry about there. However, I think the bar is a lot higher right now to raise those rounds. It may be easier if you can wait to hold off fundraising until next year, where it will probably be easier to raise money, but it might be at a lower valuation as well. And so I think there is a little bit of for later stage companies here that are whose financings are a little bit more in touch with the public markets. I think it actually is an unusually, the next kind of 6 months might be actually unusually positive, because there's a lot of I think you might start to see that recovery because of what's happened over the prior 6 months in the public markets. For seed stage founders, I think it's much more mixed. It's a much more mixed story about do you go out and try to raise money now versus waiting?
Yeah. No, I appreciate that. And I think we're going to wrap it up with one last question. And you guys kind of mentioned this a little bit, but as we say, this is the worst quarter ever. And we also talk about the bright spots that could come out of this, and a lot of factors and variables that made this. The last question for both of you is going to be, do we think the trends around global business and distribution of startups will persist into the next few years, or was this quote unquote just a phase?
I'll go and start, which is I absolutely don't think it was a phase, and I think it's going to continue to grow. And why shouldn't it? We need to be absolutely more interconnected. And I would just go and say this is there are great ideas all over the world. There's great talent all over the world. And we just need to make sure that the rails are there to connect everyone. And that's one of the main things that Brex is working on, is creating a borderless environment through, financial infrastructure. And so as an example, here at Brex, and what we think about with other startups too, is I mentioned earlier, there's amazing talent across the board, and particularly also on the engineering side across Europe and Latin America. And so, as you think about managing spend, there are a lot of great engineers at a different price point that can help scale at different kind of job levels. And so what we're seeing is a lot of founders and a lot of companies at all stages scaling their eng teams and scaling a lot of their operating staff with hires from different geographies. And so that's one thing that I don't think that trend is going anywhere. And I hope and I expect to see everything become more interconnected over the coming years.
I know from the AngelList side that one of the positive factors that we know for startups getting marked up is being in an emerging startup hub. So not in the Bay Area or New York, but in kind of some of the other emerging Austin, Nashville, Miami, Pittsburgh, Salt Lake City, Seattle, Portland, like places that are a little bit outside of the Bay Area. So I would expect that to continue. I think there might be a little bit of contrast there as well. Like my expectation in the future is that software startups will be, if not entirely remote, at least like pod based with hubs in maybe all of these places. I don't think if someone wants to live in Pittsburgh, I don't really, and they're a great engineer, I don't think, why wouldn't you hire that person? I think the contrast there is going to be hardware startups, and I think maybe something people are not really conscious of is that like there is a subset of startups where like you actually do have to go into a place every day to work on a thing, and I think there is going to be a little bit of a question about like where are these like hardware startup hubs going to be over the next decade. And I actually think it's going to be pretty foundational. I think one of the things that's going to kind of shake out over the next year or two is to really see which geographies emerge for things that can't go borderless. And that's particularly the case for hardware stuff that touches space technology or defense technology, where it has to be somewhere in the United States. Where are those places going to be? Where are they going to emerge?
Yeah, no, I think those are great points to end today's discussion on. And Jason and Abe, I would just reiterate, it's exciting to see not only the acceleration of innovation throughout the entire startup economy, but in different geographies, different locations, the amazing talent out there just looking to be hired and looking to accelerate all those ideas that are groundbreaking. So with that, we will wrap today's discussion. A huge thank you, both Abe and Jason, for walking us through the data highlighted in the Q2 State of Venture report. Angelus had such a great time partnering with Brex on this, so thank you guys for co-creating this with us. Also, a big thank you to everyone who tuned in today. We appreciate you taking the time out of your Thursday to be here with us. We will go ahead and follow up shortly with an email that links out the report so you guys can revisit that, and also this recording as well. So once again, thank you guys for the time. And Abe and Jason, thank you guys again. Have a great rest of your Thursday.
Thank you, everyone.
Thank you.